The 2008 global financial crisis became one of the most significant economic events of the modern era. Understanding how it unfolded helps explain how interconnected the world's financial systems truly are. Welcome back to Global Era Files. If you enjoy clear, documentary-style explanations about global economics and financial history, make sure to like this video and subscribe to the channel. It helps us continue creating detailed educational content for you. And if you want more updates, you can join my Telegram channel. The link is in the description. The story of the 2008 global financial crisis is one of the most widely studied events in modern economic history. It began quietly through changes in the housing market, shifts in lending practices, and the growth of financial instruments that were not widely understood by the public. Over time, these factors created vulnerabilities that touched nearly every major financial institution in the world. The crisis did not erupt overnight. It developed year after year until the pressure became too great. When the system finally broke, it revealed how interconnected modern finance had become and how a problem starting in one sector could ripple across the global economy. To understand how the crisis unfolded, it is important to begin with the early 2000s, when interest rates were relatively low and home ownership was rising fast in the United States. Many households believed that buying a home was a secure path to financial stability. At the same time, financial institutions saw mortgages as profitable assets. As interest in mortgage lending grew, new types of loan products entered the market. These included loans that required very small down payments, loans with adjustable interest rates, and loans offered to people with limited credit histories. These practices expanded the pool of home buyers, which helped fuel rising demand for houses and contributed to increasing home prices. During this period, another major development took place inside financial institutions. Mortgages were increasingly packaged together into large financial products known as mortgage-backed securities. These securities allowed lenders to sell bundles of home loans to investors. The idea behind them was that if thousands of mortgages were grouped together, the risk of any single borrower defaulting would be reduced. On the surface, this made these financial products appear safer. However, the underlying loans were diverse. Some were stable and backed by borrowers with strong repayment histories. Others were riskier and depended on variable interest rates or on borrowers whose incomes were harder to verify. As the demand for mortgage-backed securities grew, lenders had a strong incentive to produce more loans. This incentive changed the lending environment. More people were approved for mortgages, including individuals who might not have qualified under stricter traditional standards. The housing market continued to grow, and rising home prices reinforced the belief that real estate values would keep increasing. This assumption became widely accepted, even though historical data has always shown that housing markets move in cycles. With prices climbing, many homeowners believed they could refinance their loans later if needed. For some borrowers, this felt like a safety net. Financial institutions also began creating complex products known as collateralized debt obligations. These combined different layers of mortgage-backed securities and other debt instruments. The goal was to build products that appeared stable and could receive high ratings from credit rating agencies. Investors, including banks and funds around the world, purchased these products because they seemed both safe and profitable. The growing global appetite for these instruments connected financial markets more tightly than before. By the mid-2000s, the housing market reached its peak. Home prices had risen faster than incomes, which made it increasingly difficult for new buyers to afford homes. At the same time, adjustable rate mortgages began to reset to higher interest rates. For many households, this meant monthly payments increased significantly. As payments rose, some borrowers struggled to keep up. The number of missed payments gradually increased, and foreclosures began to rise. When foreclosures increased, more homes entered the market. This contributed to a slowdown in home price growth. The belief that home values would steadily rise began to fade. With prices leveling off or declining, homeowners who relied on refinancing no longer had that option. Some owed more on their mortgages than their homes were worth. This placed further stress on both borrowers and lenders. As mortgage defaults increased, the value of mortgage-backed securities and related financial products declined. These assets had been widely held by banks, investment firms, and institutions across the world. As their values dropped, it became harder for institutions to determine how much their holdings were truly worth. Uncertainty soon became a serious concern. Investors and lenders were unsure which institutions were exposed to the riskiest assets. Trust, which is essential in financial markets, started to weaken. In 2007, strains in the financial system became more visible to the public. Several lenders that focused heavily on subprime mortgages faced major difficulties. Some filed for bankruptcy, others were acquired or restructured. These events signaled that the problems in the mortgage market were no longer isolated. They had begun affecting broader financial markets. Credit conditions tightened as lenders became more cautious, and borrowing became more difficult for businesses and consumers. The situation intensified in 2008. A well-known investment bank faced significant challenges related to its holdings of mortgage-backed securities. Its reliance on short-term borrowing made it vulnerable when market confidence declined. It was eventually acquired by another financial institution after facing a severe liquidity crisis. This event marked a major turning point, showing that large institutions were exposed to significant risks connected to the mortgage market. In September 2008, the crisis reached a critical stage. A major global investment bank encountered significant financial pressure and was unable to secure sufficient support to stabilize its operations. The bank filed for bankruptcy, marking one of the most significant corporate failures in financial history. This event triggered widespread concern across global markets. Investors reacted strongly, and markets around the world experienced sharp declines. The bankruptcy demonstrated that interconnected financial institutions could face large losses if confidence disappeared. Funds that relied on short-term borrowing encountered challenges because they depended on lenders being willing to provide cash daily. When uncertainty spread, lenders became more cautious, making it more difficult for institutions to meet immediate financial needs. This created pressure on the system and amplified instability. Another large financial company that specialized in insurance products also faced severe challenges. It had issued financial guarantees tied to mortgage-related products. When the value of those products declined, the company needed to provide large amounts of collateral. This created financial strain that threatened its stability. Without additional support, the company would have faced extreme difficulty meeting its obligations. The scale of its operations meant that disruptions could affect institutions globally. As pressure grew across many parts of the financial system, credit markets tightened sharply. Businesses found it harder to obtain financing for operations. Households faced challenges borrowing for major expenses. The effects of the crisis moved beyond financial markets and into the broader economy. Economic activity slowed as companies reduced production, delayed investments, and, in some cases, reduced hiring or cut jobs. The crisis illustrated how closely connected modern economies had become. Financial products tied to mortgages in one country were held by institutions worldwide. When values declined, losses spread across borders. Countries with strong trade relationships also experienced economic impacts as consumer spending and business activity slowed. The event became global not because it originated everywhere at once, but because financial systems and trade networks were deeply interlinked. Governments and central banks around the world took steps to stabilize markets. These actions varied by country, but generally involved efforts to support financial institutions, provide liquidity to markets, and encourage the flow of credit. Central banks used tools to help ensure the financial system continued functioning. These responses aimed to prevent further disruptions and restore confidence. Over time, conditions slowly improved. Markets stabilized as institutions adjusted their balance sheets and rebuilt their financial positions. Economies faced challenges during the recovery, including slower growth, reduced investment, and changes in consumer behavior. It took several years for many regions to return to pre-crisis levels of economic activity. The 2008 global financial crisis remains a key subject of economic study. It highlighted the importance of transparency in financial markets and the need for a clear understanding of complex financial products. It also demonstrated how risk can spread quickly through interconnected systems. Economists, academic researchers, and policymakers continue to examine the crisis to better understand the conditions that allowed it to develop. The crisis influenced discussions about regulation, financial stability, and the responsibilities of institutions involved in global finance. It became an example of how important it is for financial systems to maintain structures that can handle stress. It also reminded the world that economic growth based on strong fundamentals is more durable than growth built on assumptions or rapid increases in asset prices. In the years following the crisis, financial institutions made adjustments in how they evaluate risk. Many placed greater emphasis on understanding the underlying assets behind complex financial products. There was increased interest in improving internal risk management practices. The crisis also encouraged institutions to diversify their portfolios to avoid overexposure to specific asset classes. The events of 2008 continue to shape how individuals, businesses, and governments think about financial systems. While the crisis was challenging for many people and institutions, it led to increased awareness about how global finance operates. It also provided valuable lessons about the importance of maintaining stability in interconnected markets. Understanding this historical event allows viewers to see how everyday financial decisions, housing markets, and global investment structures can influence each other across long distances. Although the crisis began in one sector, its effects extended far beyond the housing market and influenced the broader global economy. The 2008 crisis stands as a reminder of the importance of transparent lending practices, responsible financial management, and the need for strong risk evaluation in a complex global system. As we look back today, the value of studying the 2008 crisis lies not in fear or speculation, but in building a clear understanding of how economies function. Events like this help create informed citizens, better decision-making, and more resilient financial systems. By learning from the past, societies gain the knowledge needed to navigate challenges in the future without assuming specific outcomes. Historical analysis provides perspective, and it helps frame economic discussions with clarity and balance. The 2008 global financial crisis will remain an important chapter in economic history. It serves as a powerful example of how global finance operates, how interconnected modern institutions are, and how important transparency and risk management are in maintaining stability. Its lessons continue to guide researchers, students, and professionals as they work toward a deeper understanding of economic systems. Though challenging, the crisis also led to positive developments in awareness, cooperation, and the study of global financial networks. Through careful examination of its causes and effects, the world continues to draw valuable insights from one of the most significant events in recent economic memory. Thank you for watching Global Era Files. If you enjoyed this documentary-style explanation, feel free to like and subscribe for more content on global economics and financial history. And if you want regular updates, you can join my Telegram channel using the link in the description. I'll see you in the next video.